The financial markets, where fortunes are made and lost on the whim of a tweet, were rocked this week by a single post from Donald Trump. On Truth Social, he announced a 100% tariff on all Chinese imports, effective November 1st, and vague new export restrictions on critical software. The markets, lulled by months of calm, instantly panicked. Stocks tumbled, traders scrambled, and the global economy shuddered. This wasn't just a policy shift, it was a digital grenade tossed into a fragile system. Overnight, the price of everything from iPhones to garden gnomes threatened to double, and investors were jolted awake to the reality that a single social media post can upend months of economic planning. The message was clear. In today's world, geopolitical risk is just a tweet away. If stocks stumbled, crypto crashed headfirst. The crypto market lost over $300 billion in a day, a record wipeout. Bitcoin plunged below 105,000, Ethereum dropped 12%, and Solana crashed 16%. Over $9 billion in leveraged positions were liquidated, triggering a cascade of forced selling and even deeper losses. Altcoins fared even worse, with many losing 70 to 80%, some vanishing entirely. For many, dreams of quick riches turned into a harsh lesson in risk as the decentralized utopia collided with the reality of margin calls. The digital bloodbath was complete. Why did crypto collapse so much harder than stocks? One word: leverage. Crypto exchanges let you borrow up to 100 times your money, fueling wild bets and even wilder crashes. When prices fell, automated margin calls triggered a chain reaction of forced selling. No humans, no brakes, just a relentless downward spiral. Unlike the stock market, which has circuit breakers and institutional buffers, crypto is a 24/7, unregulated arena dominated by retail investors and fear. The result? Panic selling, a liquidity vacuum, and a crash that left even seasoned traders reeling. Add in recent security breaches and a sudden shift from greed to fear, and you had the perfect storm. Crypto's lack of guardrails turned a bad day into a historic rout. Wall Street wasn't spared, but its panic was more controlled. The S&P 500 dropped nearly 3%, erasing trillions in value and breaking through key technical support levels. Investors looked to the Federal Reserve for reassurance, but got only silence, fueling more uncertainty. Unlike crypto, the stock market's institutional players and built-in safeguards prevented total chaos. The sell-off hit tech, manufacturing, and retail hardest, but it was a controlled demolition, not a total collapse. Painful, yes, but not catastrophic. After the crash, all eyes turned to key support levels. Bitcoin's next test, 100,000. Ethereum, the 3,200 to 3,000 range. Solana, 120 to 140. For stocks, the S&P 500's 100-day moving average is the line in the sand. If these levels hold, a bottom could form. If not, another wave of selling may follow. Analysts are cautious liquidity has dried up, and buyers are scarce. Some see a buying opportunity, but most urge patience. The charts are flashing red, and the mood is tense. So, what's next? Analysts see three scenarios: bad, not so bad, and dream outcome. The bear case: tariffs escalate, China retaliates, and markets fall further. The base case: choppy trading, a possible bottom in late October, and a relief rally if things stabilize. The bull case: a sudden policy reversal, new stimulus, or a dovish Fed sparks a massive rebound. Key events like the October 29th Fed meeting will decide the market's fate. For now, fear and uncertainty rule, and the next few weeks will be a nail-biter. Everything depends on politicians and central bankers. If your portfolio just got wrecked, don't panic. Rash decisions only make things worse. Crashes can offer opportunities, but only for those with a strong stomach and a long-term view. Consider scaling in, buying small amounts at key support levels to manage risk. Always use stop losses to protect yourself from further drops. Be wary of battered altcoins. Most won't recover, and betting on them is pure speculation. The market is on a knife's edge, and Trump's tariff tweet was the spark. We could see more pain, a bottom, or a sharp reversal, so plan carefully, not impulsively. In the end, how did you fare in the great tariff crash of 2025? Why, liquidated, holding on, or buying the dip?